Why safety nets encourage fragility? They were built to protect the system from collapse, to catch failure before it spread, and to reassure everyone that the worst outcomes have been permanently removed from modern banking. But over time, these safety nets began changing behavior in ways no one fully anticipated. And in doing so, they quietly made the system more fragile, not less. To understand why today's banking system feels simultaneously protected and unstable, we need to revisit the moment when protection itself became a central design feature rather than a temporary safeguard. Because the same mechanisms meant to prevent disaster are now shaping how risk forms, spreads, and survives today. In the early history of banking, failure carried consequences that were immediate and visible. Banks that took excessive risk collapsed. Depositors reacted quickly. Confidence disappeared just as fast as it had formed. These consequences enforced discipline. Fear limited excess. Uncertainty forced restraint. Survival depended on caution. Safety nets were introduced to soften this brutality. Deposit insurance protected households. Emergency lending stabilized institutions. Intervention promised continuity during stress. And at first, the results were undeniable. Panic declined. Runs slowed. Confidence strengthened. The system became calmer and more predictable. But calm has effects. When failure feels less final, behavior adapts. When losses feel containable, boundaries soften. When rescue becomes expected, caution evolves. Banks no longer plan solely around survival. They plan around response. The question was not whether failure would be allowed, but how it would be managed. This subtle shift reshaped incentives. Risk-taking felt safer. Timing mattered more than judgment. Exposure expanded under the assumption of support. Safety nets did not remove discipline. They relocated it from the market to the policy response, from behavior to expectation. Over time, this altered how resilience was built. Buffers mattered less than access. Prudence mattered less than positioning. Confidence depended on protection rather than proof. The system still looked safer, but its strength was becoming conditional, dependent not on restraint, but on intervention arriving on time. This was the opening tension. A structure designed to prevent collapse was quietly teaching the system how to lean on it. And once protection becomes part of the plan, fragility begins to form beneath the surface. As safety nets became more deeply embedded into the structure of banking, they began influencing decisions long before any crisis appeared, shaping expectations, strategies, and risk tolerance in ways that were subtle enough to feel responsible, yet powerful enough to alter the system's underlying behavior. Banks adjusted their planning around the assumption that extreme outcomes would be softened, not eliminated, but managed. Losses would be contained. Liquidity would be provided. Confidence would be restored. This changed how risk was evaluated. Instead of asking how exposure might fail under stress, institutions asked how it would be supported. The presence of safety nets reframed danger as inconvenience rather than threat. Over time, this assumption worked its way into models, incentives, and culture. Stress tests incorporated intervention. Contingency plans relied on external response. Worst-case scenarios no longer included full failure. Markets reinforced this logic. Institutions perceived as protected enjoyed lower funding costs. Size and interconnectedness signaled security. Risk premiums declined, even as exposure increased. This created an uneven discipline. Smaller institutions remained constrained by fear. Larger ones operated with confidence. Protection was not distributed equally, and behavior reflected that reality. Safety nets also altered timing. Risk did not disappear, it was postponed. Problems could be rolled forward. Losses could be deferred. Adjustment could wait. Each successful intervention validated the structure. Crises were contained. Markets recovered. Confidence returned faster each time. But something was quietly changing. The system was learning that stress was survivable. That disruption was temporary. That correction could be delayed. As a result, excess accumulated gradually. Leverage increased. Complexity deepened. Correlation spread across institutions. The safety nets were doing their job. They prevented collapse. They preserved order. They maintained continuity. But by cushioning every impact, they reduced the urgency to adapt. By absorbing losses, they weakened the feedback that once enforced restraint. Discipline was no longer immediate. It was abstract, filtered through policy decisions rather than market response. This was the deeper shift. Safety nets had moved from being emergency tools to becoming structural assumptions. And once protection is assumed, risk begins to form around it. The system felt safer, but it was becoming more dependent. And dependency would soon reveal its cost. The conflict became unavoidable once the system encountered stress that tested not just individual institutions, but the expectations that had quietly formed around protection itself, revealing how deeply safety nets had reshaped behavior long before anyone openly acknowledged their influence. When pressure emerged, banks did not panic. They positioned. They adjusted. They waited. They waited because history had taught them that support would arrive, that intervention would expand, that stability would be preserved. This waiting changed everything. Instead of immediate correction, there was hesitation. Instead of early loss recognition, there was delay. Instead of decisive restraint, there was reliance. Markets behaved the same way. Participants assumed containment. They expected reassurance. They priced risk as if response were guaranteed. As a result, stress lingered rather than resolved. Liquidity tightened slowly. Confidence thinned unevenly. Pressure accumulated instead of releasing. Regulators faced a narrowing set of choices: intervene early and reinforce expectations, or wait and risk disorder. Either option carried long-term cost. Each intervention restored calm, but confirmed the dependency. Each rescue prevented collapse, but validated behavior that required rescue. This created a feedback loop. The more protection worked, the more it was expected. The more it was expected, the more behavior adapted around it. Risk-taking became asymmetric. Upside remained private. Downside felt shared. Exposure expanded because consequences felt distant. Safety nets were no longer passive. They were active participants in decision-making. Their presence shaped timing, scale, and confidence. Their absence was never seriously considered. The system was stable, but brittle, protected, but tense. This was the heart of the conflict. A banking system that could no longer tolerate visible failure, because failure would undermine the very protections it relied upon. Correction required stress. Stress required visibility. And visibility threatened confidence. So stress was managed. And by being managed, it grew. The safety nets held. But the system beneath them was quietly stretching, waiting for the moment when protection would no longer be enough. The climax arrived not with collapse of institutions, but with a quiet recognition spreading through the system that protection itself had become inseparable from behavior, and that the mechanisms designed to prevent disaster were now deeply woven into the assumptions guiding everyday decisions across American banking. Safety nets had succeeded in their original mission. They stopped panic. They preserved confidence. They prevented disorder from becoming systemic failure. But in doing so, they changed what failure meant. Loss no longer enforced learning immediately. Mistakes no longer demanded rapid correction. Consequences arrived filtered, delayed, and negotiated. Over time, this altered the system's internal balance. Resilience stopped being built through restraint. It was built through expectation, through positioning near support, through confidence in response rather than caution in exposure. The fragility that followed was not obvious. It did not show up as reckless behavior. It appeared as rational optimization inside a protected environment, as measured risk-taking shaped by belief in containment. When stress returned, the safety nets worked again. They absorbed shock. They stabilized markets. They restored calm. But each success carried a hidden cost. The system became less tolerant of uncertainty, less capable of early adjustment, more dependent on intervention arriving quickly and decisively. The resolution is not about removing safety nets. They remain essential. A modern banking system cannot function without them. The lesson is more subtle. Protection must not replace discipline. Support must not substitute for judgment. And safety must not erase the signals that warn when risk has gone too far. A system that never allows failure to be felt eventually forgets how to correct itself. And a system that forgets how to correct itself must rely increasingly on protection to survive. American banking now operates inside this tension, safer than before, yet more sensitive to disruption, protected from collapse, yet increasingly fragile beneath the surface. Sometimes the smallest shift in perspective becomes the beginning of a new future. Why?